Welcome to Skilled MBA Case Study Series in Accounting. Economic Value Added, EVA, is crucial for Ball Corporation's decision-making. It measures a project's true economic profit, considering capital costs. By comparing economic value added for a new facility versus reinvesting in older plants, Ball can assess which option maximizes shareholder value. This approach ensures decisions align with long-term strategic goals, beyond immediate financial gains. Ball Corporation must decide between constructing a new, technologically advanced metal can facility or reinvesting in recently acquired older plants. This strategic choice involves assessing long-term value creation, considering factors beyond immediate financial outcomes, and aligning with sustainable packaging goals. Economic Value Added, EVA, measures true economic profit by accounting for all capital costs. Calculated as net operating profit, after taxes minus the product of capital and cost of capital, economic value added helps determine if investments exceed their cost of capital, thereby creating real shareholder value. Economic value added matters because it uncovers the real economic profit beyond standard accounting figures. It highlights hidden capital inefficiencies, offering a complete financial picture. For Ball Corporation, economic value added provides strategic clarity, ensuring investments truly maximize long-term value by measuring if returns exceed capital costs, thus revealing genuine shareholder value creation. Ball's investment options include building a new facility with cutting-edge technology, requiring higher upfront capital but promising greater long-term returns. Alternatively, upgrading legacy plants involves modernizing existing factories with lower initial costs, though it may lead to ongoing inefficiencies. Each option impacts shareholder value differently, emphasizing the importance of evaluating capital costs. Evaluating capital costs involves analyzing initial investments for both new facilities and legacy plant upgrades. A new facility requires higher upfront capital but promises greater long-term returns. In contrast, upgrading legacy plants demands lower initial investment but may incur ongoing inefficiencies. These cost considerations are crucial for strategic decision-making in optimizing operational efficiency. The new facility boasts a 92% efficiency rate, thanks to modern automation and streamlined processes. In contrast, the legacy plant achieves only 78% efficiency, hindered by outdated infrastructure. This 15% efficiency gap significantly affects long-term operational costs and economic value added, EVA calculations, highlighting the need for strategic investment in newer technologies. The new facility boasts a 30% reduction in energy use and a 40% decrease in water consumption, adhering to zero-waste principles and a lower carbon footprint. In contrast, legacy plants face retrofitting challenges, higher resource consumption, and only partial waste reduction, resulting in a higher emissions profile. The new facility will generate over 250 jobs, necessitating relocation or recruitment of skilled workers. Advanced automation demands substantial investment in workforce training. While the facility boosts economic growth in its location, it may impact legacy communities. Understanding these workforce considerations is crucial for evaluating the facility's long-term viability and community impact. Examining the economic value added, EVA, over time, reveals critical insights. The new facility demonstrates excellent long-term EVA, surpassing legacy upgrades. This indicates superior financial performance and value creation. Analyzing these trends helps in understanding the potential return on investment and strategic benefits of choosing the new facility over upgrading existing infrastructure. Evaluating the decision criteria matrix, the new facility requires high initial capital but offers excellent long-term economic value added and very high operational efficiency. It also has an excellent sustainability impact, though with a moderate risk profile and a 24-30-month timeline. In contrast, the legacy upgrade demands moderate capital, provides good economic value added, and has a low risk profile with a shorter 12 to 18-month timeline. Economic value added, or economic value added, goes beyond traditional accounting profit by incorporating capital costs, offering a clearer picture of true economic value. It aligns strategic decisions with long-term shareholder value, ensuring capital investments support sustainable growth. Additionally, economic value added balances short-term cost management with long-term value creation, preventing detrimental cost-cutting measures. Strategic facility decisions shape cost structures, operational margins, and product quality. They influence market competitiveness and corporate culture, impacting workforce dynamics. These interconnected elements are crucial for long-term economic value-added outcomes, ensuring facilities align with business performance and value creation. EVA is crucial for evaluating if capital returns exceed costs, ensuring value creation. Strategic facility decisions influence cost structures, margins, and culture, requiring a holistic approach. Long-term value isn't always about immediate savings. Strategic alignment, as seen in Ball's case, aligns investments with sustainable value creation. Thank You and Skilled MBA offers real-world case insights, enabling you to adopt a Chief Financial Officer's perspective. By subscribing, you gain access to content focused on value-driven decision-making. For more information, contact us via mobile at +91 87553 00795, email at support@skilledmba.com, or visit our website at https://skilledmba.com.